Hi, I'm Boyd Bender from WEA Trust Member Benefits, and today we're going to discuss the Wisconsin Retirement System, Wisconsin's retirement plan for teachers and other state and local government employees. In Section 2, we'll talk about how benefits are calculated. So we'll step through the different benefit components of the formula method and also take a look at how to read your WRS statement. So now we're going to talk about how benefits are calculated, and frankly that's usually where people have the most interest. Before we set out to examine the different methods and how benefits are calculated, there's a key concept that you do need to understand. At the time of retirement, the WRS is going to do two separate calculations automatically. One is called a formula calculation, or formula benefit, and the second is called a money purchase calculation. You will automatically receive the higher of these two calculations. You don't need to choose which one you want. We are going to step through both so that you have a thorough understanding of the two, but again, this will be done automatically and you'll get the higher of the two calculations. Before we delve in, there are some resources that are excellent that will help you understand this at a deeper level. The first resource is a booklet that is published by the Wisconsin Retirement System called Calculating Your Retirement Benefits. This has lots of really good information, and I'm going to refer to a couple pages from that book as I step through the methods. They also have a website calculator available at their website, and if you have not used that before, I would encourage giving it a try. It's an excellent tool for projecting what your benefits would look like. You receive a trust fund newsletter once a year, and probably the most important resource you have available to you is your annual pension statement. And because that is so important, I want to take a moment to step through just a sample statement so that you understand how the information is organized and where to find the important things. And the first thing to make note of is what date this statement applies to. And these statements are always going to be dated January 1. So this statement is dated January 1, 2012. So this information is only as current as the statement. You'll notice it is organized into different sections, and Section 1 is going to contain the earnings and service that was reported for the current year. So it's just showing the current year's worth of earnings and service. Section 2 is the first very important section if you're trying to do a benefit projection, because this is reporting the total years of creditable service in your account. So whether you've always worked in the same school district or you've changed districts many times over the years, all of those different public employers in Wisconsin are reporting to this same account. So this is accumulation of all of your state of Wisconsin public service. What you'll notice of interest here is that they're reporting the number of years that you've performed before 2000 as well as the number of years you performed after 1999. And then they sum it at the very bottom right for a total. As we discuss the methods, I'll explain why they break those two into different sections, but for now I just want you to notice where those are reported on the statement. I'm not going to hit on each section of this statement, rather I'm going to hit on the ones that I think are most important in understanding how benefits are calculated. So that brings me to the second page, and I would highlight section number 5 before we go any further, which is your primary beneficiary designation. And keeping your beneficiary designation is of extreme importance on all of your retirement accounts, not just your WRS account. And that's because your beneficiary designations will always supersede your will. So keep those up to date, and if you don't recall who you have listed, my advice would be to just refile a new one and name it the way you want it. What I'm going to do now is bring us to section number 8, and that is where you have formula benefit data. So two things of interest here. Number 1 is on the left. This is reporting your 3 highest earning years. So those will become important when we discuss the formula calculation. You also have something called a variable excess or deficiency on the right. This is keeping track of whether you are ahead or behind for having opted to participate in the variable fund. If you don't participate in the variable fund, then you're not going to see anything printed in that section. If you are participating, you're either going to have a positive number or a negative number. And again, it's their accounting of whether you're ahead or behind for having made the decision to participate in the variable fund. Section number 9 reports the total money purchase balance in your account. So simply put, this is the total amount of money that has accumulated inside of your personal account. And there's a calculation that will use that number when we go forward to discuss those. I'm going to just touch on Section 10 as a way of giving a word of caution. Section 10 is a nice to know, but don't put a lot of stock into the projections that are printed here. And that is because the projections are assuming that the individual stopped working as of the date of the statement. So if someone were continuing to work and accruing additional service, additional contributions, and additional earnings, those are not reflected in the projections shown here. To get a true projection, I would encourage you to go out to the WRS website and plug in your personal information to do a better projection of what your benefit would look like. Of the two, the formula benefit is the more complex, and so we're going to start there. And what I always encourage people to do as we step through this is if you can grab a piece of paper and something to write with, and I want you to write a formula on this piece of paper and write it big so that you can take notes underneath each of these letters. And the formula is going to say the letter A times the letter B times the letter C times the letter D. So we have A times B times C times D. And what I'm going to do is define what each of those letters mean, starting with letter A. That is going to represent the average of your 3 highest earning years. And note how that's worded, average 3 highest earning years. It's very intentional because we're not stating that it's the last 3. They're not stating that it's the 3 consecutive highest. They're actually picking and choosing the 3 highest earning years throughout your entire career. They're going to add those 3 years together and divide by 36 months. So what we end with at letter A is what's called the final average monthly earnings. So obviously, the higher that letter is, the higher the benefit's going to be. That's the starting point for everything. Moving on to letter B, this is where we have the total number of years of creditable service that you have in Wisconsin. And again, that was reported in box number 2 on your annual statement of benefits. So the higher the number of years of service, the higher the benefit's going to be. Letter C represents a formula multiplier. Now this one is set by law, and there's nothing that you can do about it or any control that you can have. By default, the formula multiplier is 0.016. But there was a benefit improvement bill that was passed a number of years ago, and what that bill did is improved the formula multiplier for all years performed before 2000. And that multiplier is 0.01765. That better multiplier applies to those pre-2000 years. So all things being equal, those pre-2000 years are more valuable than the post-99 years. But again, those are set by law. And that brings us to letter D. And the best way I can describe letter D, which is technically called an age reduction factor, is by explaining that a pension system will always set a normal retirement age. And that's the age when they set up the calculation that they expect people will retire. And the normal retirement age in the WRS is 65. So if someone were to retire prior to the normal retirement age, the WRS is expecting to pay that person for a longer period of time based on life expectancy. And because they're paying them for a longer period of time, they can't afford to pay as much. So that's the simple concept. So I refer to letter D as an early retirement penalty. So let's explore how this one works. I believe that this age reduction factor is probably the idea that gives rise to the most misunderstanding when I talk to members. And what I mean by that is I've talked to many folks who believe that once they hit 30 years of service, they have maxed out their state pension benefit. And so I want to examine why that's not necessarily true. I'm pointing to the age reduction factors chart in the Calculating Your Retirement Benefits booklet. You can download that from the Department of Employee Trust Fund's website. I want to draw your attention to the age 65 column, and that's on the far right-hand side. What you'll notice is that the factor in this column is 1.0, regardless of how many years of service this individual has. So if I plug 1.0 into our formula, what we're getting is an unreduced benefit. Next, I want to draw your attention to the age 57 column. And let's follow that down and assume that someone has 23 years of service. You'll notice that the factor where those two intersect is 0.910. And if I plug that factor in our formula, it's effectively a 9% reduction in the benefit. So let's do one more. Let's keep that age 57 individual and slide down now to 30 or more years of service. Now the factor again is equal to 1. So what we found here is there are two ways that we can eliminate that early retirement penalty. First, of course, retire at 65 or later, but secondly, retire at age 57 or later with 30 or more years of service. So let's look back at our formula and now imagine that we have a 1.0 plugged in for letter D. So that would be a pretty significant event, a pretty big plateau to hit. But if we were to continue with employment, our letter B, which is the years of creditable service, would continue to increase. So we haven't necessarily maximized our benefit. We have reached an unpenalized benefit, however. So that's just a point to clarify on how the formula benefit works. So we've covered A through D, and simply all we're going to do is multiply those four together, and the result is going to be the monthly benefit under the formula calculation method. There is one thing that we haven't addressed yet, which is the variable excess or deficiency. Because if someone had opted to participate in the variable fund, nowhere in that calculation did we reflect their experience in participating. And so, if we put parentheses around our formula and then have a plus or minus E on the end of it, what we're going to do is have an adjustment based on whether you're ahead or behind in that variable fund. We're going to go back one more time to our booklet, and I'm looking at Table 2. So we're dealing with a 57-year-old individual, and you'll notice the factor on this chart is 0.00568. What we'll do is look at the variable excess or deficiency, and that's going to be a dollar figure, and multiply that dollar figure by the factor in this chart. To break this down real quick, for every $1,000 of excess or deficiency, that would result in a $5.68 adjustment to the monthly pension amount, and that again is for a 57-year-old. If it was a different age, of course, the factor would change a little bit. That gives you a sense for what kind of adjustment might be present if you participate in the variable fund. If it's a deficiency, it will be a subtraction. If it's an excess, it would be a little bit of an add-on. All right, so that concludes the formula. And next, we're going to cover what is called the money purchase calculation. This one of the two, again, is much simpler to understand. At retirement, the WRS is going to look at the total balance of money in your personal account. And they're going to take that number and multiply it again by the factor in Table 2 of the Calculating Your Retirement Benefits booklet. So we just looked at an age 57-year-old, and looking at the table in the book, the factor again would be 0.00568. So they would multiply that big lump sum of money by that factor, and that would generate a monthly benefit. Finally, they'll compare the two calculations and give you the higher of the two. This concludes Section 2. I would encourage you to view Section 3 next, especially if you're thinking about retiring soon. And in that section, we'll talk about the 7 different retirement benefit payout options that are available, what they mean to you, and how to make the best selection. We'll talk about beneficiaries and what, if any, benefits they are eligible for if you pass. Thanks again for joining us today.